Good morning. Welcome to Traders Workshop, Options Brew TV. The guys are going to break it down today. We're going back to Birdland. I think we got the seagull today. Let's check it out. Good morning, guys. How are you? Jason, Mark, what's happening?
Good morning. I thought you were going to make a Charlie Parker reference there.
I wasn't going to make a Charlie. You know what I was going to make a reference to? The Chicago Bears. Why? You're wondering why? Because there's new talk in Chicago about the stadium and whether it's moving or not. And the city just threw out a huge $2.2 billion renovation plan to try to keep the Bears in Chicago proper. I don't know, Mark. You're kind of a Chicagoan in a way. Any thoughts there?
Soldier Field's a pretty epic part of Bears legacy, I gotta say. You know, not a Bears fan myself, but having spent enough time there, you get a sense of appreciation for that spot.
I know. I never go because it's so darn hard to get to. And the new stadium proposed is in my neighborhood, essentially. I mean, it's literally five minutes away. I'm not sure that's good or bad, but you know, nevertheless, it's close. I might go to two more games in my life.
Then. Do pretend like you're in Wrigleyville and sell parking spaces.
There was a trader at the SIBO who had a side business selling parking. He owned parking lots around the United Center. It wasn't the United Center then; it was, the stadium. But yeah, unbelievable. All right. Well, anyway, let's get into it. I'm gonna start with Mark. I'm gonna come to you second. Jason, I'm gonna go to you first. You were talking about something that was perplexing, I guess, or maybe not perplexing, but about VIX and VIXI and something else. And you said there's vomit or something, or VAMA, some vomit numbers. So tell us about vomit or VAMA.
I'll tell you about it. My dog vomited this morning in his cage.
Perfect.
That's
yeah. What order of Greek was that? Perfect.
It was that's a true story, by the way. Anyway, no, yesterday I was just talking about how VIVIX was up 10 points. VIVIX being the index of it's like a VIX calculation on VIX options. So VIX options are typically used to hedge VAMA in SPX options. So what it essentially means is that a lot of maybe market makers or somebody was buying the wings in VIX. That's typically a sign of increasing skew or also just basically fear of a tail risk happening. It could be hedging. It could just be tail risk hedging. CPI is next week. I think Jerome Powell's talking or something in today. But it could be nothing. It could just be hedging and people are coming back into the market. But it was kind of an anomaly, especially on a day where you didn't see a big downturn in the market. It was only, 1% or something like that. Yeah. And you saw kind of a big move in that index. That's not typical.
Yeah. So just for definition and for understanding and clarity, what is exactly VAMA? So we've talked VANA on this show. We've talked Charm and Gamma. What is VAMA? How would you define that?
VAMA is the volatility of volatility. It's basically if it's the Vega version of if I were to draw an analogy, it would be, Vega is to VAMA as Delta is to Gamma. So it's the movement of volatility, like the convexity of volatility, I guess you could say.
Okay.
How's that, Mark? Is that good?
It's pretty good.
Yeah, it's no bird. Analogies. It's no bird, but it's pretty good. So
yeah, I'm trying to keep it concise,
Yeah. So before we jump to Mark's bird spread here, any thoughts from either one of you guys on? I've been looking at earnings a little bit. Disney had some pretty good earnings, yet they're laying off a bazillion people. There's a lot of layoffs in the tech space, right? Any thoughts around that? What's going on relative to that? I mean, besides the fact that everything's so damn expensive, and my grocery bill is $200 every time I go get a taco. But otherwise, anything going on in your minds about these earnings calls and some of these layoffs? Mark, Jason,
I don't know that I have any specific insight into what's going on there. I mean, I know Iger's obviously coming into Disney. He's got to put a restructuring plan in place. They've been hemorrhaging their money on Disney Plus and whatnot. Probably similar reasons to why like a lot of the tech sector's laying people off. Honestly, I was just going to make a joke about how AI is just going to come and take our jobs, right? Microsoft's putting all their money into ChatGPT. Google just had their announcement yesterday of the Bard, and they're coming for our jobs, man.
Yeah. So that's funny you bring that up, the GPT thing, the Chat GPT. I've been messing around with that for the last several days, and I'm doing that summit again for for SIBO and Tradier. And I just randomly said, give me 5 great questions on implied volatility, let's say, right? And it comes up with 5 great questions. It's amazing. And then I said, give me 5 great questions on VIX, specifically VIX with implied volatility. Fires out 5 great questions. It's amazing. I'm writing poems and prayers and questions. I'm fascinated by this. So I think you're right, Mark. We're going to get replaced by a machine.
It really is incredible, and it absolutely nails those kinds of aggregation questions or like factual things. I ask it like SQL and Python questions all the time, like how do I do this simple thing, and it'll give you boom instructions.
Yeah.
How do I smoke ribs? Fantastic at that.
Right. It's amazing. It really is. Look at I'm working with this thing and writing things out. I even had a couple questions about easy ones like state capitals and stuff. Just those are like the AI guy saying, "Leave me alone. That's too simple." I'm having it write. I had it write a poem for me, and I said, "Oh, my 35th wedding anniversary is coming up this year. Can you write me a little something for the inside of the card?" Oh, it was wonderful. I tell you, better than I could ever come up with. All right, let's get to the bird. What do you say? Someone just said, ask how to deal with an angry wife. I agree. That's a tough one. You can't answer that question. All right, Mark, have at it. So what I have, you have something to share, right? You want me to bring that in now?
Yeah, sure. We can talk about that. So, one of the things that I've been tracking here, and we've talked about this trade a number of times too before, is the whole Seagull structure. And we often talk about it because it's basically the trade structure that JP Morgan uses in their hedged equity fund, which is, that massive hedged equity fund that, often has some pretty significant implications in terms of gamma positioning going into expiration and dealers and whatnot. So what this tracks right here is how much upside does protection cost? So the idea being that, this trade structure goes out and it looks to find, or it looks to trade the 5% out of the money, 20% out of the money put spread. So buying the 5% out of the money put to sell the 20% out of the money put. So you have a nice protection. Stock goes down anywhere between 5 and 20%, you're covered. So you lose the first 5% and then you lose everything after 20%. But it provides that real nice sort of buffered exposure to that sort of midterm downside,
right?
Or mid-range downside, I should say. And then to finance that, instead of going out outright and buying that put spread, they sell the call against it. And so this is interesting. It's sort of like a put spread collar would be another way that people describe this, that you sell a call to not just buy a put, but to sell another put further out of the money, kind of keep your cost structure, relatively,
right. I'm sorry. How far out of the money is the short call?
So that's what depends. And that's exactly what the lower green line is tracking here. And so it'll range anywhere, like in SPX as of yesterday. If you were going to put this on, I think it was like a 6% out of the money call. It can be as low as 4%, as high as like 8 or 9% even in SPX. So really what this is a function of, and kind of a nice follow on to what Jason was saying about VVIX, is in a lot of ways the variation here is a function of the skew. Because as the vol environment changes, which I've got vol environment plotted in orange, there is some change, right? The calls and the puts are going to bend a little bit more as overall implied vol is changing. But broadly, calls go up, puts are also going to go up. but that price of the 20% out of the money put relative to that call, that's really where you're going to see that shape of the curve changing. The distance out of the shape of that curve is going to change how far out of the money you need to go to sell that call.
Okay. So you have a put spread that you're long, and you're using a call essentially to offset the debits on that put a little bit, right?
Correct.
Okay.
And so you have a nice little collar around. You generally, as an investor, you want to do this for as low cost as possible. People look for free collars or zero cost collars, but this gives you a nice range of up. You get the first 6% of the market, and you don't lose more than 5%, or everything after 20%.
I got you.
So it does provide a really nice. I think the fund has a relatively high Sharpe ratio because the ball is significantly lower relative to their returns.
Mm-hmm. Okay. So this is a position you'd put on an existing stock position. Is that accurate?
Yeah, it's great for an index, SPY, Qs, it's something like that. It's a great way to, provide buffered exposure to the market that,
Yep.
The highs are lower, but the lows are also higher.
Yeah. So let me bring in kind of a schematic of this with a trade. Okay. Can you see that?
Mm-hmm.
So this is called a seagull, and there's obvious reasons. Look at the shape of that graph. This is the risk graph of this trade. So it kind of looks like a little seagull flying over the water, right?
You didn't put the stock in.
Well, see, I didn't put the stock in because I think that changes the dynamic of the seagull, right? The way it will look. I can add that. But this is what the seagull looks like to cover that stock position, right? Mm-hmm. And I did this out in May, which is about, I think it was 98 days away. I just did one lot just to get a flavor for this. So, Mark, you're saying that depending on where I choose my call strike and my long put strike to start, right? That's a function of some metric that you're using to find the best possible spot. Is that right?
Well, the call strike is determined based on the cost of that put spread. So if that put spread is going to cost you, what's it costing you, like $5 or $6, something like that?
Let me see what I did here. So I've got a credit in this whole thing, I think, right? So right here. And I think I can do better. So I should be moving this around so that it doesn't have to be that big of a credit, right?
Yeah, no, ideally you get this down to zero cost. So you can sell a higher up call for less money to get you closer to flat on that.
Okay. I gotcha. So I'm going to move this call. It's at the 430, so I can go up to 460 even. Oh, that's a debit. We don't want to go there, right? 28 cents at the 50 line. So all I'm doing is moving my call strike to a place where we have a reasonable credit. So I get to 82 cents credit. I mean, I'm sure we could play a little bit. We can go up a strike maybe. Right? So are we trying to get some credit, or are we trying to just get kind of flat?
I generally think about flat just because that's sort of an easy benchmark, right? What's the zero cost aspect of it? But that's the beauty of this kind of trade, right? You can pull the legs. It's the beauty of any trade with options, right? But you can just pull the legs exactly where you want it. So, you want a little more running room because you're looking at Bolland and you're seeing how much attraction we're at the 4,300 level, then boom, like pull that up a little higher. You can pull in, sell a little bit richer out of the money put instead of 20%, sell something 15% out of the money.
Got it.
To, very customizable.
Okay. Yeah. So what I just did too while you're talking is I got it to zero. I mean, literally zero. So I moved strikes around to get it to zero, which is, I wasn't trying to do that, but wonderful. I like
other than last.
Yeah, go ahead,
Other than last year, the biggest risk to the Seagull trade was the call. You would miss out on quite a few gains because you were selling that call too close because skew was too high.
Right.
Or not high enough. But yeah, so I mean that's just a thought.
Now, what if you add? Sorry, Jason. What if you add the long call to this to protect yourself even? I guess you have the stock on, so that's like your long call anyway, right?
Mm-hmm.
So you're gonna
exactly. You're just capped out above that short call. You're flat P&L. But I think to Jason's point too, like that is the tough thing about putting a strategy on like this. Because, 90 days out, you think you're giving yourself 6% upside. Great. 4 times a year at 24% a year. That's a fantastic. That's 3 times the market averages.
Sure.
But as we all know, things don't go up in an even straight line where you get 2 bips a day. That like a lot of those gains will come within the course of a month. And so you miss out on all that if you're short too much.
Sure.
All your losses will come, the next month. So it's obviously not a linear march upwards. And that's where any sort of covered call strategy can get a little dicey.
Gotcha. So what I did then, I added the stock, Jason, to the equation here. So you can see how it flipped the seagull. The seagull is now flying to the east toward the Atlantic, as opposed to the west toward the Pacific. So when you put the stock in, you can see how it lifts up this side of the curve. Where am I? This side of the curve, right? So your stock acts as your nice call. So you got a covered call of sorts, right? And then a put spread on that all of a sudden. So, kind of cool. I like it. Mark, I never heard of seagull in my life. I got to be honest.
You never heard of one?
Well, and we talked about this a year ago, and you brought it up, I think, a year ago or so, the seagull, and I had to do like a Google search on it. I didn't know it. It was never a trading floor term.
I think it comes from. I had not heard it from my floor days. I've heard it since. I believe it comes from FX options. That it was an FX term.
Okay,
I don't
didn't know
why,
that.
but
yeah. So do you? Yeah, go ahead. Sorry, Jason.
No, I was about to say, Lex, if you never heard of a seagull, just go to McDonald's and spill your French fries outside. You'll find a seagull.
You find a seagull, right? I got it. And Mark, you actively use this strategy, right? For some of the stuff you're doing in real life.
Yeah, it's a great wrapper around a long stock position, right? Whether it's an index or an individual name, like this sort of like balance protection, right? Like I said, the highs are lower, but the lows are a lot higher, and like that's very desirable for a lot of investors, that they don't need the chop of even a 17 vol product like SPY. They want something even a little bit calmer and smoother that lets them sleep instead of worrying about what Jerome's going to say.
Sure. And what was your statistic on it in terms of the percent per month you can get, and if you annualize it, it was some number. You mentioned it just a few minutes ago.
Well, just the idea that if it says you're selling a 6% out of the money call, and you do that 4 times a year, like that sounds like you're giving yourself potentially 24 points of upside. But the path dependency really matters. That does not compound linearly like that.
Right. I gotcha. Okay. And you also mentioned if we fold in vol.land into this, and all of a sudden we can start seeing some gamma clustering and Vana clustering on this in places. Then all of a sudden you might be able to even enhance your strike choice, especially on that short call part, right? So there might be some guidance from the vol.land folks. Call Jason De Lorenzo. So,
exactly. I mean, that's like the kind of, instead of a totally fixed rubric, you use something that's got some extra information and use that to kind of adjust your positioning instead of just following a strict formula.
Yeah. Jason, what were you saying? Sorry.
Yeah, no, if you choose your strikes wisely, using Voland, I mean, you can get yourself more of a credit or cover yourself more than you would normally.
Right. And can you Mark, do you find that you do this in individual names, or you're always using an SPX/Spider/QQQ type product to hedge a portfolio? So the reason I ask is because I just put in 100 shares of Spiders here. But if you have 100 shares of Apple and 100 shares of this and 100 shares of that, do you throw QQQs on the whole portfolio, or do you do them individually on the stocks themselves?
For the most part, my experience is just with the indices, right? That this is kind of a nice way to kind of manage the overall like risk profile of like broad-based, well diversified, low fee index funds, which I think make up a great, cornerstone for most investment portfolios.
Mm-hmm.
But I think you could get interesting, right? Like if you have a bunch of individual names in your portfolio, layering on a QQQ structure onto that could be a way to, hedge something without necessarily, hedging the individual positions.
Yep. And you do it. You do this trade, the 3-legged trade, as a package, right? You don't do the put spread and leg into the call side or vice versa, right?
No, typically I'll execute it as a package, and it's also a margin question, right?
Mhm.
Having that naked short call in something that you don't actually have the shares for, that can get expensive fast.
Right. Yeah, and I'm going to make my plug for portfolio margin in a second, right? Or not in a second, right now. Um, on that. So to that, if you have portfolio margin sort of access, then you can use that in the whole portfolio. So it would look at the entire portfolio as a shock to find out what your margin would be. So that's one of the pleasures of portfolio margin for people who don't know what that is. So that's a nice feature, I think. And Mark, you and I lived that world in portfolio margin in the floor days. That's how we, leveraged our trading capital, right?
Yeah, I think market maker margin is even slightly better than portfolio margin.
It
I forget
is.
what the exact edge cases of it are. Well, actually, speaking of margin, we had a question a couple weeks ago that I chased down the answer to,
Okay.
but I forgot to bring it up. Do you remember what I'm going to bring up?
No, it's why is Jason's headphones only show one ear, not the other ear? No, nothing. There it is. He's back.
We were talking about condors, another bird, of course.
Yep.
And we were talking about the margin differences between an iron condor and a true condor. So, because we were talking about like what's the best trade that if you know where stock's going to be, what's the best trade?
Yeah.
And like I think the default answer we were talking about was butterfly, and Jason had the interesting point that if it wasn't going to be exactly at the strike, a condor might make more sense.
Right.
And so we had the question of, is it better to be long the condor from the iron perspective, where you're long the put spread, long the call spread,
Yep.
or short, or are you long that all calls are all puts, long and short all calls and all puts?
Yeah. So one is called a condor, one's an iron condor. Is that accurate?
Correct.
Okay. So yeah. Right. So here's the condor. I'm just going to make one up real quick. This is an actual condor here that I'm making. So all I did, you can see
Who's
the
got
line.
construction going on back there?
I know it's Mark.
That's me. I'm sorry, guys. Yeah,
That's all right.
and that's 2 floors above me. So
Jeez.
imagine what my upstairs neighbors are hearing.
You're
So
in the
here's
cellar,
the-
man.
That's right. Here's the iron condor. I'm sorry, the condor. So it's all on the calls. I just did on the call side. So it's the deeper call debit spread, and you've got a call credit spread, right? So, and you can see that it becomes a debit here. If I move this over here, the call legs and made it an iron condor, you have two
Are
credit
you sharing
spreads now.
something, Lex?
Oh shoot! How am I doing? Yeah, now I am. I'm talking to myself. It's like the little old man on the beach looking for a stone. So what I was saying is this is the call spread down here, and I'm all on the call spread, and this is the short call spread. So I get a small debit out of this, but this is considered a condor, right? This is not considered an iron condor. Iron condor is in the credit version is the credit put spread. So if I remove the lower strike calls, I think that's this one and this one, and then I made it into a put spread, we're going to get the same graphics of risk, but now I've got two credits, right? So we were debating which one of those is going to be halfway decent if we knew where the stock was going to kind of be as a condor. If we know exactly, maybe a butterfly might be a good one.
Well, what I was saying, I mean, two things to note about iron condor versus condor. In the money options tend to have less liquidity than out of the money options.
Good
So
point.
iron condor, especially when you're putting things on, is a lot better suited. But I mean, when you look at that, go back.
Oh, sorry. I'm back.
So like, let's say you told me right now that the market was going to close exactly at 417.
Yep, right here.
Whatever this is,
my
SPY or
cursor.
whatever.
Yep.
Then a butterfly would work. But if you told me it was going to close at 416.50, you would have to do math to see if it would be a 415, 416, and then 417, 418 iron condor, or if it would be a butterfly on either 416 or 417. Like it's not quite clear.
Yeah. Well, you realize though, if I knew kind of where it was, I'm going to be greedy, and I'm not going to do a one strike Condor. I'm going to take this here and move it way up here, right, and spread these out and get bigger credits all over the place. And then I'm going to start
If
saying,
you're only
well,
doing,
go ahead.
if you're only doing one strike, if you could only do one lot, then yes, spread it out. But
Yeah,
you would make more money if you squeezed it into one strike and did more
spreads.
spread. Yeah.
Yep.
Did more lots.
Yep. Actually, right. Okay. I like it. All right, guys. I see we're
We're gonna get
over
greedy.
time. I like, yeah, greedy. Who would be greedy? I mean, there's no such thing as greedy in the trading world.
Hey, if you get tomorrow's newspaper, you got to take it all the advantage you can of it.
I know. I always had that dream. I get to see tomorrow's newspaper today, and it would be like unchanged, right? That would be
It
my
would be
luck.
boring.
It would be unchanged. Everything would be unchanged, and I had to collect theta for a night instead of really hitting a home run. No fun. No fun.
You get tomorrow's newspaper, but it's Friday.
That's right. That's right. No trading on Saturday. All right, guys. Good to see you as always. The Seagull, I love it. Vama, we got into Vama. It's the Vega of Vega or something like that is what I got out of that. But we'll dig that deeper next time. Right? You guys have a good week, and I'll talk to you after.
Happy trading.
Thanks.